Watch it later. Well, good afternoon, everybody. My name is Rich Harvey, CEO of Property Buyer. And thanks so much for joining our webinar today. Terry Ryder, great to have you on board with us today. Terry?
Always good to be here. I love talking about real estate, and I like doing these webinars with you. We always get a really good audience and just have a great discussion from our two different perspectives on. I'm the person behind the scenes doing research and looking at numbers. You're actually at the coalface of the industry, and
That's
quite
right.
often I find that while the research data can be really interesting, it's actually the anecdotal evidence from people actually there on the ground every day, which is often more valuable than what the numbers are saying.
Often the data lags, doesn't it? But for those that haven't been on our webinars before, I run a buyer's agency, national coverage, and we service home buyers, investors, commercial buyers, and even developers purely on the buying side, giving independent advice. And Terry runs a fantastic research company, Hotspotting, providing wonderful reports, which we use, giving very granular insights into many locations right around the country. So great to have you on board, Terry. Now, Terry, what we're going to do today in terms of a summary or an outline today, we've got a bunch of questions that I'm going to ask you and you're going to ask me. And then we're going to open it up to the floor. And if anyone there online has a question, just on the bottom of your screen, we have a Q&A button. So if you'd like to press that, write your question in as we're talking. And then at the end of the webinar, we'll probably allow around 20 minutes for Q&A and try and answer as many individual questions as we can. So Terry, we're going to be talking about what to expect in the property market in 2025. But before we go looking forward, I just want to ask you, what surprised you about the market overall in 2024? Was there anything unusual that stood out to you in the property market?
Look, I think 2024 pretty much panned out what we expected. As usual, we don't have one market in Australia. We've got lots of different markets locally. So we had some booming markets, some moderate markets, and some falling a little. I think the one that surprised me the most is that Melbourne continued to underperform. Really did expect Melbourne to do better this year. Not totally understanding, I have to admit, why Melbourne hasn't sort of done better, because it's got some strong metrics, including population growth and a big infrastructure spend. And it's quite an attractive proposition on price compared to Sydney at the moment. But we'll talk about that probably a little bit later. That's perhaps the only surprise. I wasn't surprised that the economists started the year predicting prices would crash everywhere, and they got it wrong, because they always do. I wasn't surprised that our elected representatives have failed to come up with any solutions to the housing shortage, and particularly the rental shortage. They really are clueless. And so we continue to have low vacancies and upward pressure on rents and prices. So possibly the only other thing that's a little bit of a surprise to me is the propensity for investors to be herd animals and to dive into frenzied markets, which are at their peak or beyond their peak, rather than investing sensibly in places that are at the right time in the cycle and have good long-term prospects for growth, rather than that short-term sugar hit that people seem to be looking for.
Interesting. Yeah.
Okay. What's been your take on the market in 2024? Anything that surprised you?
Yeah. So for me, I think the strength or resilience of the market, even in the face of higher or jumped up interest rates. I mean, interest rates on your mortgage are back to like 6.5%, which is where they were many years ago. But just the strength, the fact that we had significant price rises in Perth, Adelaide, Brisbane, and other parts of Australia in the face of rising interest rates. So I think it's a point we'll make today, is that interest rates are not the primary driver of the property market. They're just one of many factors. And also just the diverse results we got across all the different cities. Some areas spiked, some areas, as you say, Melbourne went backwards, some areas just flatlined. But I think overall, just the amazing value in the residential market is now valued at $11.1 trillion. Like, I remember doing many of my webinars before a few years ago, and it was like 8 trillion and 9 trillion. Now it's $11 trillion compared to super. That whole market's worth 3.9 trillion. The share market's worth 3.2 trillion, and the commercial market's worth 1.2. So it just shows the dominance of the residential sector as a massive wealth creator and store of wealth.
Yeah.
I think the other thing I was surprised about, Terry, was just how fast and how quickly Perth went up compared to the other cities. And it's also been interesting to see just how the media and also market conditions just affect buyer psychology and seller psychology. I think we see a lot of people waiting for something to happen. They're waiting for this to pass by. They're waiting for the right time to sell or waiting for smooth waters. There's, I guess, what I call a lot of hesitation still out there in the market. And hopefully we
Yeah.
can address some of those issues today, you know. But Terry, back to you. How do you see this sort of multi-speed nature of the property market playing out across Australia in 2025? Which regions do you think are going to move first?
Yeah. Well, firstly, I'd say that multi-speed markets is the norm in Australia. That's a very big country. We don't have one property market. We never do. And so it's quite normal because I always believe that real estate markets are local in nature. They arise out of local economies. And it's significant that, the economies that are rated the highest, like, for example, the State of the States report by CommSec, like Western Australia and South Australia, that's where we're seeing the highest price growth, Adelaide and Perth, for example. So, very, very local, driven by local economic events. So that's going to continue in 2025, but we're going to be seeing different locations performing. The evidence is quite strong to us that the Perth market has passed its peak and we're starting to see a fading of that boom. So it's not the right time to be piling to that market. So if anyone out there is thinking of joining that frenzy, I would urge them to think very carefully about what they're doing. We're seeing listings rising in Perth. We're seeing the rate of price growth falling. We're seeing sales activity dropping, even though there are more listings now available in the Perth market. We're seeing rents have actually been stable in Perth. They haven't been rising since about March. So a lot of indicators that that's happening. Adelaide continues to truck on. It's had several years of strong growth from a low base, still producing strong metrics. So still expect to see some good growth in Adelaide in 2025. Regional Queensland's going to do very well. It seems to be the new flavour of the month for investors, and we're seeing some very frenzied markets already in regional Queensland, like Rockhampton and Townsville. It's very hard to buy with due diligence in these places, and I'm sure that your team as buyers agents know that. I always urge people, if you can't buy with due diligence, then don't buy.
Just on that, Terry, I did a promo the other day filming for the REA Hot 100. So they've got 100 suburbs coming out, and I think we nominated around 25 suburbs on that list. So they gave me a little, marketing piece to camera. And one of the questions they asked me was, what's the one piece of advice you'd give about the Hot 100? And I said exactly what you just said then, was if you can't visit the property, you can't visit the location, make sure you use someone who's gone through and inspected the property, who's experienced with the local market and knows it well. That physical inspection makes all the difference.
And in addition to that, a lot of people in buying these frenzied markets, to beat the competition, because there's multiple offers on a property, they've got to basically have an unconditional offer, which means no building and pest inspection. I think that's really risky stuff.
Very dangerous. Yeah.
Yeah. So, and it's not, if the market's like that, then you're probably buying at the wrong time in the cycle. And I think as we progress further in our discussion today, we'll be talking about some of the places where it's perhaps more sensible to buy. In terms of next year, regional Queensland will be strong. I do expect to see some revival in Melbourne and Victoria, which has underperformed for the last couple of years. There are some reasons for that, but nevertheless, I'm expecting better performance there. Well, we're finding growing interest in Darwin as a market, and we're seeing almost daily little scraps of information indicating that Darwin's time to shine might be coming. It's a very affordable market. It's got the highest rental yields of the capital cities, and it hasn't sort of performed for the last couple of years, but I think it'll do better in 2025.
Okay, interesting. Thanks for that.
So you touched on this a moment ago, Rich, but interest rates is a hot topic, and so do you have an opinion on where we can expect cuts and just how important that will be? Because I know that the media and the economists tend to think that this is the be all and end all of what's happening with property, and you've just commented that it's actually just a factor, not the factor.
That's
So
right. Well, I'm just going to put my economics hat on from my past experience and get my crystal ball out. So actually, I've thought about this question quite a bit for you, Terry, and I think interest rate changes will come next year. I think there'll be, possibly two cuts, maybe three. But the thing about interest rate cuts or changes is that they take about 12 to 14 months to wash through the economy to have the full impact. So if you think about when the last interest rate rise was, that was on the November 7th last year. The cash rate went from to 4.1 to 4.35%. Now, banks were very quick to pass on that increase. I get those beautiful love letters from banks saying, "Dear Rich, your loan has gone up X percent." We all got those letters or emails.
well,
Um,
don't say it's gone up, Rich. They'll say your interest rate has changed.
Changed. Okay, that's very, very politically correct, right? And we saw that the RBA started raising rates at the end of 2022. So the first, we saw those rates really jump up significantly, and since then it's raised 12 times. So we've had a lot of rate rises to deal with, and it's taken a long time for people to really either have their buffers reduced and change their spending behavior, and that's why inflation is sticky. So economists out there, I talk to them all the time and interview them, and they're always continually revising their expectations, looking at their assumptions, and that's why you'll see the financial markets changing their predictions month to month, depending on what's happening with some critical factors. And the critical factors are, number one, that the inflation band needs to go between 2 and 3%. They're going to be looking at the rate of unemployment and also the pace of economic growth. So those three things are the most sort of top order priorities that the RBA wants to see in alignment before they'll do a rate cut. So for me, I think it'll be April at the earliest, most likely May, and then we'll probably see a cut number two in around September of next year. So, and the other thing to note, Terry, you've only got the RBA meeting 8 times a year. They're not meeting 11 times a year like they used to. So they're not going to be as responsive as they used to be in the past. So that's a factor that's coming in. It's just the timing of those meetings and when the data comes out. So it's not monthly.
It's also important to note that it's which inflation measure that they rate, because there's one inflation measure that says inflation is where they want it to be, but that's not the one that they look at. They're taking out some of the highs and lows and the impact of the federal government throwing money at people to pay their some of their bills, and that's not a real reduction in inflation.
So I reckon once you do see a rate cut come into play, it will just create a lot more confidence in the economy and in buyer behavior. It won't see the market boom, right? It's not going to be like a 0.5% drop or a 1% drop. So it's just going to create a bit more confidence. I think a second rate cut will cement that confidence. You'll find that people have got a bit more borrowing capacity, and then you've got a bit more potential for price uplift. But what's going to happen is more investors will come into the market, more home buyers will step off the sidelines, and generally affordability will improve a little bit. So I think it's a gradual thing that you're going to see next year in terms of interest rates.
Okay.
Terry, question for you. I want to talk about regional areas. So we saw that regional areas really went crazy after the pandemic. People fled to the regions, sea change, tree change. Do you think we're still going to see those regional areas outperform in 2025, or do you think people have got regional regret and the trend will reverse?
No, it's not going to reverse. Like it wasn't driven by the pandemic. It's been underway for longer. It's essentially it's about affordability and lifestyle enabled by technology. Those are the key factors. So if you look at the population analysis for Sydney, for example, it's been losing population to internal migration for over 10 years now. It gains population with overseas migration, but it loses it for people moving to other parts. And that was happening long before the pandemic came along. Technology enables people to work remotely, more so than in the past. So that's still the case. Affordability remains a big issue, particularly in cities like Sydney. So the motivator for people to seek greater affordability and a different lifestyle remains. And the numbers that are coming out, we've got a regional movers index, which is updated regularly by the Regional Australia Institute, I think it's called, and I think CoreLogic helps them put that together. And it's showing that the flow of people from the biggest cities to the regions continues, is still as strong as ever. So I don't think it's going to reverse. I
Mm,
don't think it's going to slow down. It's
mm.
just part of the norm now.
Yeah, I think the affordability factor is driving, a lot of my son's friends are moving to Central Coast or even further north, Newcastle, for example, because it's just what they can afford to buy. So I think that will push people into those areas. So I think as long as there's good lifestyle and good amenities, those areas will perform. I do see a little bit of people coming back to the city though. Either they've been called back by their workplace or they've got to visit the office 2 or 3 days a week. So I think there's a little bit of that. But I think the regions are still going to be pretty strong. Yeah.
Yeah, and more and more investors will be targeting regional areas for their greater level of affordability, but also the higher rental yields that you can obtain there.
Mm, mm.
So, Rich, what do you predict the banks will focus on next year? Will it become easier or harder to secure financer as a home buyer and as an investor?
Well, I think first thing, Terry, being cynical, the banks are going to focus on profit first and foremost. Commonwealth Bank will probably come out with another $1 billion profit tag, right? As they
And we
always do.
saw that move yesterday that caused an outcry, starting to charge people for withdrawing funds. I think,
Oh, crazy. So look, I think, look, we're very fortunate in Australia. We've got a really good, strong banking system, and there's lots of checks and balances. So I think the banks are going to continue, on their risk management process and really maintain tight lending criteria and making sure they're compliant with all of the regulations. I think one thing to talk about is the APRA serviceability buffer,
yeah,
and
that's
I
the big
think this
issue.
is likely to continue, Terry, but I personally think it should be reduced for first home buyers. I think they're at a real unfair disadvantage in the fact that they've saved a deposit and often they might put in a smaller deposit, but they still got to pay that, that or be assessed on like a 9.5% repayment rate. So I think reducing that to say 2% just to give them a little bit of an edge would be a fair thing to do. Whether they do it or not, I don't know. But APRA is also very cognizant of just reigniting lending and not seeing lending take off to accelerate the market too strongly. I think it's probably going to be just as hard to get finance next year. I think when the interest rate comes down a bit, yeah, it'd be fractionally easier when you get those rate cuts. But I think whether you're a home buyer or an investor, the trick to getting finance approved is pretty simple. It's not it's hard, but it's simple. Number one, you've got to have a good job. You've got to have a stable job and you've got to have a reasonable income. Secondly, make sure you pay off your credit cards every month. Don't have any defaults. Have a fantastic, perfect credit record. That's super important. And make sure you set up a savings program for your deposit or recycle equity from another property. And lastly, I'd say make sure you use a really good finance broker, reputable finance broker that do all the running around for you. And let me know if you need a recommendation. I've got some great brokers we work with. Mm.
Yeah, and it's really important for people to use mortgage brokers. There are so many loan products out there. I think there's a product to suit all situations or most situations, and
Mm, mm,
it's really hard for the average consumer to keep abreast of all the parameters without engaging an expert to
mm,
help them through that.
mm.
But there's no reason why someone with a steady job and a good credit rating can't get finance
That's it.
to buy real estate.
Terry, I want you to put your political hat on. I know you're not short of a comment on this question, but with government policies just constantly shifting, is there one particular policy change that you think could drastically change the impact of property buying power in 2025?
Oh, look, I think the change that has to happen is that governments, particularly state governments, have to stop persecuting investors. They've got to start realizing that investors aren't the problem, they're the solution. We have a shortage of landlords in this country. That's the biggest shortage that we have. And I know it's politically unpalatable to certainly some in politics, but really we've got to turn that around. We're not going to fix the rental. They seem to think that it's all about how many houses they built, and that, of course, takes time. And there's also barriers to that because there are shortages of tradespeople and materials and delays in the system. The short-term fix and the proper fix is to incentivize people to be property investors. That's the change that has to happen. Until we do that, you can build 1 million new homes, but if investors don't buy a big chunk of them, we're still going to have a shortage of rental properties. I just don't know. We've still got media full of talk of actually going in the opposite direction even more, which is scrapping negative gearing and scrapping what they call the capital gains tax concession, which isn't a concession at all. It's an imposition on investors, and no one else has to pay this thing. So, we really got to, I think the big thing that happens in Australian politics is that rather than fix problems, they scapegoat. And the popular scapegoats at the moment for real estate problems are foreigners, students, migrants, foreign investors, very popular scapegoat, and Australian investors are the other one. They can slam them as much as they like and hit them with new taxes and not suffer too much electoral damage. And they've got to stop scapegoating and actually fix the problems. That means actually incentivizing investors.
Yeah. I think certainly immigration volumes is something that both sides of politics is trying to grapple with, but it's very difficult to slow it down because they've got the conundrum of if they slow it down too much, it's going to impact GDP growth and the whole economy because we need immigration to keep our economy running and growing at a sustainable rate. I think at a state and local level, putting my policy hat on, the simple things that they can do is continue to look at rezoning laws and bringing in higher density, especially high and medium density in the suburbs and higher density along train lines where there's existing infrastructure. So rather than building lots of new greenfield sites, is trying to build more infrastructure around and housing around existing infrastructure.
They've got to go further than that. They've got to address the fact that it's hideously expensive to build homes in Australia now. You can, like Melbourne's done it. They've rezoned all these areas to encourage investors to build apartments, but the development industry is saying, look, sorry, we can't build the apartments you want us to build because it's not financially viable. The costs are so high that the price we'd have to charge for the end product is so high, the market won't pay that price. It's only the luxury downsizer market that works. Now, there are reasons why construction costs have got so high, and they have to address that. Their taxes, fees and charges, their delays and red tape and all of that has to be taken out of the system so you can actually build the houses and apartments we need at a price that the market can afford to pay. So just moving on and being mindful that so many investors are seeking higher returns if they can get it because interest rates are high. What property types do you see as being the ones offering the best returns next year? Is it houses or are units? Is it their time to shine?
Good question. We get asked a lot of this in our strategy discussions with clients. Should I buy a house or an apartment or a townhouse? And houses have traditionally been probably offering the strongest returns simply because they have higher land content and often located in areas where there's very limited supply. But with units, affordability constraints and changing demographics is changing and increasing demand for units. So I think that's going to have much more higher appeal in 2025. Terry, I did a bit of analysis over the last 25 years. I dug out the median house prices for a number of areas, especially the major capital cities, Sydney, Melbourne, Brisbane. And I looked at the annual growth rate in each of those capital cities. Now, for houses, the annual growth rate in Melbourne, Sydney, and Brisbane was between 7.5% and 8% per annum for houses. Now, the same annualized growth rate for apartments was 5 to 5.5%. So what it showed me was that during the last 25 years, houses have outperformed units by around 2%. However, going forward from this point, affordability constraints are going to be much higher because in Sydney, you need 9 to 10 times income. Melbourne, you need 7 or 8. Brisbane, you need around 7. So I think there's going to be a resurgence in demand for apartments simply driven by affordability. The other thing is I want to talk about the gap between house prices and unit prices in lots of suburbs. And this is where it's a bit of a goal for our viewers today. There's an absolute opportunity to buy well in good suburbs, but consider buying an apartment rather than buying a house. So I'll give you a couple of examples, Terry. So Mossman, beautiful Mossman, North Shore of Sydney, a median house will cost you around $5.84 million today. $5.84 million. The median unit price is just a paltry 1.4 million, Terry. So
only 1.4.
Just 1.4, right? It's all relative, right? But the gap is massive, like a massive gap. Rose Bay in the eastern suburbs. To buy a house, average price, 6.65 million. Now, the median unit price in the east for Rose Bay is 1.7 million. Now, if we head south to Toorak in Melbourne, median house price 4.4, and the median unit price just 865,000. So
Mm,
what I'm saying is like where there's a big disparity between a house price and a unit price in a suburb, there's a greater propensity or opportunity for capital gain in the apartment market where there's high demand, low supply. Now, let me just finish with giving you a couple of caveats, or our viewers a couple of caveats on that. We're actually buying quite a few apartments for our investors in Melbourne at the moment, where we're literally getting them, I believe, almost purely at land value. So the fact you've got an apartment on the property is a bonus. So I've just bought quite a few in those middle and inner ring suburbs around Melbourne. So as you'd mentioned, the replacement cost or the build cost is so high for apartments at the moment that buying established apartments provides excellent value. So I think that's one little bit of a tip that I'd be giving to our viewers out there.
I think there are lots of examples, Rich, in major cities are across. Brisbane's got some great examples like the Ascot Clayfield area where you're paying $2 million for a typical house, but the median price for apartments is sort of 500 or 600,000.
Mm,
Examples in inner Sydney, in the inner west of Sydney as well. So we're saying similar things to investors that target those suburbs where there's a big disparity in price
mm,
between
mm,
luxury homes, houses, and apartments.
mm.
Prospects for capital growth.
Yeah. Terry, I've got a research question right up your alley, but do you think as prices start to slow or stabilize in some areas next year, as you mentioned, how can our investors identify high growth suburbs before everyone else buys there? Is there any kind of tricks up your sleeve in picking, really, for want of a better word, the winners next year?
Yeah, well, I think partly it's a question of identifying locations with good long-term prospects. They've got the credentials for long-term growth, and we can talk about what they might be. But early in the cycle, the growth cycle hasn't started yet because what we're seeing investors doing as typical herd animals is diving into the markets where the frenzy is already well underway and buying at or past the peak of a market, which isn't particularly sensible. So I just want to perhaps share my screen and illustrate a couple of points
Yeah, please.
to help answer that question. Um, so I hope you can see there. What I have on screen there is from our research portal. And this is the suburb of Armidale and Perth, which is a classic frenzied market. This is one that's been particularly targeted. It's only a couple of years ago you could buy houses there in the 300,000s. Well, now it's in the 500,000s. But this is what the 5-year median price chart looks like. So you can see that's been a very steep rise in prices. And this figure here shows us in the last 12 months, its median price has risen 42%, probably the highest individual price growth performance in Australia. Days on market 14 days. When properties are selling within 2 weeks of being listed, it's a frenzied market. These are the sorts of markets that many investors, not thinking too clearly, have been diving into. Just another example, Berserker, oddly named suburb. The market has been going berserk in Berserker. This is a suburb of Rockhampton, which is another frenzied market. You can see how steeply the price graph has risen in this suburb, and it's typical of Rockhampton and a few other places in regional Queensland. Days on market 17, so property selling very quickly. Median price has grown 23% in the last 12 months, and its 5-year growth average is almost 15% per year. So it's already had extremely strong growth. Now, this is not a market to be jumping into. It's also a market I know from personal experience that you can't buy with due diligence there. There'll be 15 or 20 offers on a property, and to beat that competition, you're going to have to offer an unconditional contract, no due diligence. Otherwise, you'll just get beaten by others. Not sensible investing. What we're saying to people is try to find those markets that have the credentials for long-term growth, but have early in the cycle. We call them second wind markets. So a lot of markets in Australia had that COVID uplift. Say from 2020 to 2022, there was big steep rise in the price graph, and they've been flatlining since then. Those are the markets to buy when it's at that sort of flat stage of the cycle before it starts to take off the way Rockhampton has, the way Perth suburb have. So an example, a suburb in, say, Bendigo in Victoria, which is, Bendigo is a great regional city, not so far from Melbourne, very affordable. And you can see that from about 2020 up to about the middle of 2022, very steep rise in prices, but that cycle ended, and since then prices have flatlined. This is an opportune time, if you believe in the future of Bendigo, to buy while the market is still a little bit flat. Days on market 42 compared to, say, 12 or 14 days in Perth and those Rockhampton suburbs. So you can buy in a market that's not frenzied. You can buy with due diligence at the right point of the cycle, provided you believe that Bendigo has a strong future, and that we're going to see this kind of steep upward rise in prices in the future. That would be sensible investing. I certainly believe that Bendigo is a great regional city with a very strong future. Another one that we really like is Albury-Wodonga at the border between New South Wales and Victoria. And this is a market which has performed really well in the past. It's a great regional city, really strong, diverse economy, great location. It's within a couple of hours. A lot of big businesses have distribution centres there because it's within striking distance of Melbourne, Canberra, and Sydney. It's on the Inland Rail link, which is going to be an influence in the future. But you can see this too, this market, steep upward jump in prices up until about the end of 2022, and it's kind of flatlined since then and just starting to nudge upward again. We know from our anecdotal evidence that more and more investors are starting to show interest in Albury-Wodonga, and Lavington's one of the cheaper suburbs of that market. So you can still buy in the 400,000s there. It hasn't grown much in the last 12 months. We think it's going to show really good growth in 2025 and beyond. So that's the sort of market that we think people should be looking at rather than those frenzied markets. And Dubbo in New South Wales is another example. Again, it shows that pattern. It had a period of 2 or 3 years of growth. The graph has flattened out a little bit, and it's just starting to rise again. Days on market 42, so you can buy there without massive competition. So I don't know what you think about that, Rich, but for us at Hotspotting, those are the sort of markets that make sense to be buying in rather than jumping in to those frenzied ones.
Yeah, I agree. I think, any market that's had a massively, steep run for a year or two or even more is likely to run out of steam because it's just not going to have the same drivers forever, and affordability constraints will come there. So I think the sage advice, as you say, Terry, you just got to analyze the local numbers, analyze the demographics, the infrastructure, look at the supply and demand forces and what the future viability of the area is before you jump in.
Yeah, okay. So we've been talking a little bit about some of the risks that are out there in the market, including people diving into frenzied markets and buying without due diligence. In 2025, what are some of the risks do you think that home buyers and investors need to look out for, and how can they prepare themselves to deal with those sorts of things?
So I think I'd recommend people either take notes on this response because it's a really good question, Terry. And I think that one of the biggest mistakes that I see people making is not having a clearly defined strategy. They'll think, okay, I've got a pre-approval and just jump on realestate.com and go, okay, I've got 600, I've got 800, I've got 400. What can I buy for my money? Without thinking about reverse engineering the process. So my advice is look at your end goal. Okay, you want to end up with $150,000 passive income. What's the strategy that's going to get me to that point? How many properties do I need to buy? What's the location? What's the property type? How much time do I need to spend analyzing the local market, visiting those properties, working out what to pay, completing the due diligence, and then finally negotiating well? They're all the steps that we take as buyers agents for each of our clients and help them get a much better outcome than they do on their own. I think the other big mistake, apart from strategy or lack of strategy, is buying in a location where there could be a serious oversupply down the track. So buying in greenfield areas, for example, rather than existing established areas where there's propensity for major subdivisions or massive high density volume blocks coming. Thirdly, I'd say don't touch off the plan or house and land packages that have got overinflated prices stacked with hidden commissions. You're much better off to buy established properties in most locations. Don't just simply buy because you're getting a nice tax deduction. I'd also say avoid, expensive mistakes by getting a pest and building inspection or a strata search done. Classic mistake some people make, oh, I won't spend the $500 on the pest and build because I think it looks all right. Don't trust yourself. Make sure you get it done. And finally, the other sort of risky strategies that I see talked about a lot, Terry, is around NDIS. It seems to be flavor of the month. Now, NDIS in the right areas could work, but I do see some people buying in areas that might be oversupplied with too many of the same type of product because you're buying in a very niche market. So just be very careful before you get lured in by the high returns to make sure you've done enough research to know you're getting a property that's going to deliver 12% like they're promising. Instead of, I'm hearing some of the funds that are actually funding these NDIS are having troubles with their redemptions at the moment. So if the big funds are having trouble with NDIS, that's alarm bells for me. I'd stay right away. And lastly, sorry.
You do have to be very careful. I mean, it can potentially deliver great returns, but you've got to get it right. You really do have to tick all the boxes to qualify. If you don't do it right, you can spend a lot of money and not get the outcome you want.
And lastly, I just see people trying to run ahead of their expertise and skill and trying to buy, small, large, or medium development sites, thinking that'll fast track their process to get to wealth, and they lose a lot of money in the process because they're running ahead of their knowledge and experience. So again, it's just about getting the right style of strategy that's going to work for your personal financial situation and comfort level. Terry, I want to ask you a question about, I guess, global uncertainty. We've got Donald Trump in power in December, in January. We've got wars going on overseas and international issues. How are all these things going to play into the impact on Australia's property market, or will there be no impact?
I'd say pretty much zero impact. I know media likes to chatter about some of these things as, they're going to have an impact, but really, I can't think of a single instance of where sort of global events have had a big impact on Australian property markets. Now, we're a pretty strong and powerful economy in our own right, and real estate markets are very local. I can recall that when the war started in Ukraine, that one of the most high-profile economists in Australia predicted that Australian property prices were going to drop about 15 or 20% as a consequence of the war in Ukraine. I never understood the logic of it. And of course, that didn't happen. It was never going to happen. But that was the view expressed at the time by a very high-profile and senior economist that was proven to be false. So, we've got plenty of factors to consider on our own doorstep without worrying too much about. I know the world is volatile, but I think it's always volatile, isn't it? Donald Trump's coming into power, but he's been in power before. So we have an idea what to expect. I just don't really see it being a factor.
Yeah, I think don't let it mess with your head, Booby. Don't let the media mess with your head. It'd be my message, mate. So, yeah.
Well, media loves to sort of conjure up disaster scenarios. They like to talk about cliffs, don't they?
Yeah.
Mortgage cliffs, etc. None of those cliffs have ever actually come to pass. And we've been told.
I was listening to a really top guy the other day, one of the ex JP Morgan head honchos, and he was talking about Donald Trump coming into power. And if you look at his style of negotiating, and everyone's worried about his tariff war, right? He's threatening, 50, 60% tariffs against China. What he does, he kind of berates his chest going, I'm going to deliver these massive tariffs. And then he kind of comes in and slides in a 10 or 20% tariff, right? So instead of going to the extreme, he might come back to a more moderate level. But I don't think Australia is going to suffer from tariffs. I think we have a very strong relationship with the US, and I think that we're going to be fine. So I wouldn't have a worry that we're going to see massive negative implications from that. The only issue is going to be if the tariff rates are too high with China, just what that might do to our demand for our resources sector going into China.
Yeah, I don't think we should be spending too much time worrying about that. What is more of a concern is issues closer to home, like housing affordability, continues to be a concern. Lots of chatter, of course, as always. Politicians, we've been talking about this not for years, but for decades. It only ever gets worse. Do you think it's going to get worse in 2025, Rich? And any strategies that buyers can consider to sort of deal with that?
Good question. I think yes. I think housing affordability will get worse. I think unfortunately it's going to become out of reach for more people. And the traditional number of 30% renters will probably end up going to 35% over the next decade. I think one of the biggest issues is supply constraints. We've got continued delays in housing projects, and we've got continued growing population. We're just simply not building enough houses to satisfy demand. So Albanese government came up with a goal of 1.2 million houses over 5 years, 250,000 per annum. But I think this current calendar year, we're going to be lucky to build 140,000. So we're already, what's that, 110,000 short. And you touched on it before, Terry. The simple fact is the feasibility of building brand new apartments and other sorts of properties like that simply doesn't stack up because construction costs are so high, land costs are higher, and there's excessive taxation on developers. So we're going to become more undersupplied over the next decade than ever before. And that's just been driven also significantly by migration numbers. And I've got some figures I'll share with you. I can just pull up my slides here. I'll just show you a couple of slides. Here we go. Share. I'll just move that one across to there. All right. Oh, this is one just a quick point I'll just make too, just about consumer sentiment's been in the doldrums around 80 points for quite some time. But the last couple of months, the positive news is we're all feeling better about ourselves, right? So we've got it up to about 94 basis points at the moment, which is pretty cool. So yeah, we're going the wrong way. I'll send these through. Oh, that was the other point I was going to make. I meant to put this up earlier. Just the jump in median prices in each of the capital cities has been quite significant. You look at, Sydney's gone from almost 1.1 to almost 1.6 million in 5 years. And yet we've got Melbourne going from, 852 to just over a million. So Melbourne's, 60% cheaper. There you go. But the point I want to make about migration. Okay, so look at this chart from Macro Business. We've seen here, from 1950 to early 2000s, we've had, around about somewhere between 150 to 200,000 migrants per annum on average. But look at the last 20 years, and particularly the last 3 or 4 years, massive spike in migration. Now, if we look at how many properties are being built, what we call completions, not approvals here, I want to make this point. This is completions, actual properties built, not just rubber stamped to be built, because some of them don't get built, even though they get DA approved. It hasn't been too bad. It's been around, on average, about 160, maybe at a touch 170,000. So that's what we're averaging. So yeah, not bad, but we need to build 250, right? So let's look at, as here, Albo's housing target, we're way below. So, I think we've got Buckley's chance of getting there in the next decade. It's a fanciful target. And the other point to make is we've got population growth, this green line here, spiking, and then commencements and approvals plummeting, going the other way. So it's a complete role reversal into what needs to be happening to actually satisfy demand going forward. I'll share those slides too. Sorry, Terry.
And the big takeaway from all of that for people out there thinking about getting the market is that it represents opportunity for those that can get into the market. We're not going to see any downward pressure on prices or rents anytime soon. Quite the opposite.
Like for me as an investor, Terry, those numbers really excite me. I mean, as much as it's telling a sad story, I'm excited as an investor and a home buyer because I know that my equity is going to increase substantially in the next 10 years. If you look over the last 2-3 years, we've had almost 1 million migrants come in. I think the number will drop to somewhere around 395, and then in 24-25 around 260. But good luck to the government trying to slow down demand for employment. And as you saw on the dwelling completion side, it's pretty significantly problematic. So. In terms of strategies, I think it's good for investors to have a longer term view of the market, not just a short term view of the market. Terry, so onto that question, do you think if you're an investor, do you think you need to wait? Should you just be jumping into the market now, or is there an advantage in waiting for certain economic conditions to change and improve?
No, I don't. If you're ready to go, then you should go now. I think there are a lot of people out there who are wait and see people. And I tend to think, perhaps rather cynically, that the sort of people who will never take action. If you're always waiting to see what the Reserve Bank does next month or what's the outcome of the next federal election, then you're probably always going to find a reason to procrastinate and you're never actually going to take action. Um, if you're getting into real estate investment, you should be considering it from a long-term viewpoint. It is a long-term play. So what's happening right now with interest rates is irrelevant because of the life cycle of the real estate you will own, interest rates will rise and fall. What's happening currently in politics, who's currently in government, it's irrelevant because that will change over the life cycle of your ownership of real estate and the development of your portfolio. If you're ready to go, you've got all your ducks in line, there's nothing to wait for. Just make sure you get your choice of location and product right and buy at the right price, do your due diligence, buy sensibly. But if you're ready to go, go now. There's no advantage of waiting.
Okay. Very good.
So Rich, I've got a few more questions I wanted to ask you, but I'm also mindful that time is ticking by, and we want to allow some time for people's questions. I think there are some there. Do you think we should perhaps have a look at the questions or that people have that are waiting? Or
Yeah, sure. Let's just jump into the questions. I'll come back to one or two more. I just wouldn't mind asking as well. But let's jump into maybe just ask two more questions and then we'll open it up to the floor if that's okay.
Okay, so we're always looking for property at the right point of the cycle. Probably that's perhaps undervalued. Are there some areas of the market that you see as being undervalued, and how can buyers take advantage of those opportunities?
That's a good question. Actually, that'll answer Bruno's question here about Andrew's question about Melbourne, I think it is. So I think that's the number one area I'd say in Australia. If you want to buy in an undervalued market, is consider Melbourne. So as I mentioned, its median price is way below, and the gap between that and Sydney. I think Melbourne represents good value long term, Terry, because it's got the right volume of population. It's got a very, very diverse economy. Unfortunately, the state government has really trashed the economy through very, very high taxes, but governments will change. I reckon those tax regimes will change over time as they realise their mistakes. And instead of trying to tax investors out of existence, they'll actually create incentives for investors. I mean, they did create the incentive for off the plan, no stamp duty for off the plan, but that'll just help the developers to make it slightly more attractive. But I think there's a lot of what we call old money in Melbourne. We've also got a very vibrant migrant population in Melbourne. So I think those two factors particularly will be very, very good for Melbourne's long-term growth. And obviously continued infrastructure development right across the city. Other, I guess, undervalued areas or also areas of value uplift, I would say, would be, again, Sydney, around the Western Airport. We're seeing some good opportunities there to buy well. I'm even seeing eastern suburbs, like apartments in the eastern suburbs of Sydney is actually pretty, there's a bit of a lull in the market. Same on the northern beaches in the inner west. We're seeing a bit of a pullback in pricing. So for those super blue chip suburbs, there's opportunities to buy in. I think Brisbane, to do a quick rip around the country, I think Brisbane's going to give the best combination of growth and yield next year. It's going to continue to have a really good news story, not just because of the Olympics, but simply because of the 110,000 interstate migration that's going across the border to southeast Queensland. So Gold Coast, Brisbane, and the sunny coast, fantastic lifestyle locations. I think they're all going to do really well. I'd also suggest Central Coast and Newcastle. You're getting the ripple effect out of Sydney. Perth, I think, as you've indicated, is a bit hot. I'd just say you can still make some money in that market, but I think it'll run out of steam after about another year. And then also Adelaide, I think, is representing still good buying. And then your large regionals like Townsville, Mackay, Bundaberg, Rockhampton, those sort of areas I think will do quite well, Terry. Terry, maybe just one more question for you before we go to the other questions is, what are some ways in which investors could future-proof their investments? Is there anything that buyers can do to sort of future-proof and stay more resilient as they look toward next year?
Yeah, I think it comes down to the question of the sorts of places that you will buy in, the sort of economies that underpin the location that you're buying real estate in. So we're always looking for, locations that have strong and diverse economies, a significant infrastructure spend. We have what we call actually our empirical formula. And empirical is one of those. I can never remember what we call it. Is it an acronym where each letter of the word empirical actually stands for something? The E is for economy. So we're looking for strong and diverse economy. The I in empirical is about infrastructure. We're looking for locations that have a big infrastructure spend because we've seen many examples in Australia where a big infrastructure spend generates so much for real estate markets, both when things are being built, but also if they're like hospitals and universities, what they generate in terms of real estate demand after they're completed and up and running. We're seeing that on the Sunshine Coast, for example. So yeah, applying those basic formula to the sort of location you're buying is the way to perhaps future-proof your investment. Make sure it's not a risky place. It's not a volatile market. It's not a mining town. It's not a location where the only economy in play is like the tourism industry, which can be very fickle and up and down. You want something strong and diverse, jobs being created, money being invested. Those are the sorts of places where you can find safety and steady long-term growth.
Excellent. Good answer. Terry, to your point, let's go to the questions on our screen. So we've got about 8 or 9, and please keep your questions coming, folks. We love questions. This is what we love to have that interaction with you all. So Bruno's asking, SQM research, the Bust and Boo report's just come out from Louis Christopher, which is always a really good read. He's usually very accurate researcher. He's saying that Sydney, Melbourne will see price drops subject to rate cuts on the back of Melbourne's 24 performance or underperformance. How do you feel that regional Victoria will perform, e.g. Ballarat and Bendigo, on the backdrop of a weak capital city for the state? Generally, we're told regions follow the cities, albeit with a lag. What's the relationship in this case? What are your thoughts on that?
Well, I really don't agree that the regions follow the capital city. I know it's an attitude that's out and about there, but I don't think there's any real evidence that that's the case. Good, strong regional cities have their own economies, and they tend to perform independently of the capital cities quite often. I don't necessarily agree that Melbourne's going to be weak next year. One of the places that Bruno mentioned was Ballarat. We actually see Ballarat as a real opportunity at the moment because Ballarat had really excellent growth from about 2020 to 2022, and since then prices have come back. Really good value for money in Ballarat. You just got to believe that this city has a future, and we believe it does. It's a really strong regional economy with a strong future, we think. So there's really good buying there at the moment. So that's the sort of opportunity we're suggesting that people should be looking for.
Excellent. Okay. I think I've answered Andrew's question about Melbourne already. Brett's asking, are you seeing any buyer's remorse from people who moved to regional centres? As someone who lived in regional New South Wales for 35 years and shifted to Sydney, visiting my hometown for a long weekend was 2 days too many. Excellent. Love that, Brett. Yeah, look, as I mentioned, I know personally some people that moved to the regions and, they discovered the climate was too cold or too hot and then realized, oh, I'm missing my family or missing my network and, moved back. Unfortunately, they sold before COVID and moved back after COVID and, lost $500,000 in the process. So I think we are seeing buyers move to regional areas for affordability reasons, and I think it's going to continue. And some will move around for jobs. So I think it's just going to be a continual flow based on people's individual circumstances.
Yeah.
Brett's also asking, according to ABS downsizing, more than 70% of Australian households have at least one spare bedroom. More than 1 in 10 households have 3 or more spare bedrooms. Surely there must be more incentives to downsize. What can be done? Well, Terry, this is an interesting one. One thing I know that can be done is already there is the payment of $300,000. If you sell the family home and you're over 55, you can put $300,000 per adult, or if there's a husband and wife, $600,000 into your super fund as an incentive. Are there any other incentives, Terry, you think could be offered there?
Yeah, it's not really a great incentive, as I said. Look, I know the nation would like older Australians to downsize and free up those family homes for younger Australians, but if they want that to happen and expect that, they've got to actually do something meaningful. The reason why a lot of people who would like to downsize don't is because the cost of doing so is prohibitive. You know, stamp duty. We've got stamp duty concessions or exemptions for first home buyers. We've got to bring that in for downsizers as well, because you could easily tear up $100,000 selling your existing home and buying a new one with stamp duty and legal fees and selling fees. Until that's addressed, we've got no real expectation or right to expect that people are going to downsize just for the benefit of the nation, because it's just so costly to do it. And I know plenty of people who would like to but can't afford to do it.
Hmm.
So they've got to address that, because, yeah, I mean, it is a major force in the market, but
I
what
think,
stops
Terry,
it?
the biggest thing that can be done is like particularly in Sydney and can be done in Melbourne is the missing middle legislation. So bring in more medium density housing opportunities so that people can move out of the big family home but not move out of the suburb, because so many older people, they just love their local area. They've got their friends, their networks, their family, and they don't want to move too far. So if more medium density housing can be provided, I think that's a big draw card. And that's why those developers targeting luxury downsizes is selling so quickly, because people are prepared to pay a premium to stay in those areas. Let's keep moving. We've got a bunch more questions. Would you have examples of those types of second wind markets in Queensland, please? What do you think, Terry?
Yeah, some of the Queensland regional markets have gone beyond second wind. They're now actually rising strongly. Rockhampton and Townsville are cases in point. Ones that are a little bit earlier in the cycle, starting to get busy, include Mackay, which is a very good place to consider. It's starting to get quite competitive, but it's not as frenzied as Rockhampton and Townsville. Gladstone's another one. Bundaberg, I think, is a good one to consider. Very affordable. That market's going to be massively boosted by $1 billion hospital that they're now starting to build. That's going to create big demand during construction and particularly after it's finished and it's operating. Harvey Bay, I think, is potentially a good one. It's had a period of growth up until maybe 2 years ago, and it's been flatlining since then. It's ready to rise again, but hasn't really taken off yet. And there's a part of what's in prospect for Harvey Bay is a massive new resort by Sheraton. It's not the sort of market you would expect Sheraton to do one of their resort hotels in, but they're targeting Harvey Bay for its qualities. So that's another one. And consider also some of the smaller, well-located regional centres like Gatton between Ipswich and Toowoomba, and maybe Kingaroy is one that maybe people don't know so much about, but very affordable, and it's got some good growth drivers quite early in the cycle there as well.
Mm. Excellent. Someone's asking about the legislation that was just passed last week in federal parliament around the impact of the Help to Buy scheme. What's your thoughts on that too, Terry? My thought is just it's around, I think, is it 40% of the capital gain is taken by the government, but I think you've only got to put up 2% deposit from memory. Is that correct? Do you remember?
Like I'm not quite sure of
It's a very small deposit. I know it's a small deposit, but basically the government takes a significant in consideration of the government putting up the majority of the deposit, they take a significant portion of the capital gain. So I think, look, it'll help a certain number of people that otherwise couldn't afford to get into the market. I think the caps on the amount I think I forget the caps, but I think that will mean it's only limited to sort of certain suburbs. I don't think it's going to have a dramatic impact, but I think it'll have a marginal impact overall. Mm.
Look, I think I mean, yeah, it'll help some people, but I mean, it's another example of politicians tinkering at the edges and not dealing with the real issues. If they really want to help young people get into a first home and do something for the economy, they
Mm.
need to address the hideously high cost of building new homes. You know, a house and land package. Can you produce a house and land package anywhere in Sydney for less than, say, I don't know, 800,000? Most parts of Australia, you just can't do it for less than 700,000. Now,
Right.
there are reasons why the costs are so high, that they are things that politicians can actually do something about it if they have the political will.
Mm.
That's where they should really be focusing now, bringing
Mm.
down the cost of
Mm.
construction of new dwellings. And they
Yeah,
would solve a lot of problems if they could do that. And they can. They've got the will.
it's great. David's having a bit of fun touring Dub Vegas. Thanks, David. Chris is asking, do you have any thoughts on Wollongong Units Apartments? Great spot. There's been a lot of development. What do you think? Yeah, look, Wollongong's a great town. Fantastic on the water, close to Sydney. You know, you got the national park in between, great lifestyle. Yeah, I would just be really careful about, you know, as I said, I prefer to buy established apartments because I think they're cheaper and better value wise. Just don't buy in areas where you know there's going to be a stack more development going through. Next one's asking, do you consider Perth a mining town? No. What do you think on that question, Terry? It's certainly
No, well,
connected
it's
to the
not.
resources sector, but you know, not every job is a mining job in Perth. No. Mm,
No, there's some pretty silly definitions of mining towns out there. I saw a report out there from one of the major research houses suggesting that most of the best growth in regional Australia have been in mining towns. When I looked at their list, they were talking about Townsville and Mackay. They're not mining towns, they're regional cities, which do have some connections to the mining sector, but they're not mining towns. And Perth is obviously a
mm,
capital city. They've worked pretty hard in Western Australia. They're aware that they had a vulnerable ability to the fact that their economy was so tied into the resources sector, and they've been working to try and diversify and strengthen it. And they've
mm,
had a certain level of success. I think the Perth market's going to be less volatile in the next 10 years compared to what it was in the previous 10, but it's certainly not a mining town.
Okay. Any thoughts on the Canberra market, Terry? What's your thoughts on Canberra?
Never gets discussed, does it? No one
No.
ever gets excited about investing in Canberra. Like one of the problems is that it's a very expensive market to get into.
Mm,
And you know, most of our cities, they have their cheaper areas and the more affordable areas. But Canberra is like everywhere is expensive. I don't think there's a single suburb with a median
mm,
price below 700,000 in Canberra.
mm.
But we do note, because we're always analysing the sales activity figures, and we've just done the latest quarter, and there is signs of uplift in the Canberra market. Um, but yeah, I just find it a little bit hard to get
Yeah.
excited
My
about
thoughts
it.
about Canberra, Terry, are it's obviously a very stable market because you've got a lot of government employees from stemming from that. So it's fairly stable rental market. Median price 1,042,000. So yeah, you need the right coin to get in there. It's just a matter of if you had the money and you could diversify after buying in other areas, then I'd consider it. But yeah, I think it's definitely got legs, but it's going to track along, you know, pretty. It won't be a dramatic crash, but you're not going to see dramatic rises either in that market. A fairly stable market. Mm.
Yeah.
Question. Thanks for the webinar. Have Australia's economy developed any decent immunity from the US catching a cold lately due to high risk coming from massive debt crisis? Okay, so the question is more around, will we catch a cold if US has a debt crisis? And I think, well, we just like we saw during the GFC, there was a major ripple effect right across every developed country from that. So yes, we could catch a cold, so to speak, if there was a major financial meltdown. But as I said before, our banks are also very resilient. And I think the way to avoid any risk in your own portfolio is to make sure you have buffers, to make sure you've got good tenancies locked in, and make sure you're monitoring all of your finances on a monthly basis. Any thoughts, Terry, on that? Mm,
I think it's a similar answer to the one that was asked earlier, and I talked a little bit about you know, the Ukraine factor that was predicted to happen but never happened.
mm,
Um, yeah, I
okay.
think you know, Australia is sufficiently strong and resilient that it can withstand some of those forces that potentially might be out there.
Yeah. Okay. Someone's asking about Warrnambool. What's your thoughts about the location of Warrnambool, Terry?
Look, it's kind of had a peak recently, and it's probably not the right time to be getting into Warrnambool. You know, we talked a little bit earlier about second wind markets. Markets that sort of peaked a couple of years ago and a flat line and are ready to go again. I
Mm,
think Warrnambool had fabulous growth up until very recently, and it probably is going to be in that flat line phase for another year or two before it rises again. So I don't think the timing is absolutely right for Warrnambool. Um, I mean, I always suggest people ask themselves the question when they're considering a location, is this the absolute best place in Australia that I can invest right now? Because all of Australia is your market. Um, and I would suggest right now, Warrnambool is not the answer to the question, where's the best place I can buy
Mm,
for myself
mm,
right now. I think
mm,
there was 3 years ago, it would have been a great place to buy, and maybe a couple of years from time, it might again be good, but not right now, I don't think.
mm. Okay. And Chen's asking, Brisbane offers great capital growth. Would you include apartments in the CBD as well? Good question. Not necessarily, Chen. I think the Brisbane apartment market, particularly areas like Newstead, New Farm, where there's been significant, and Hamilton, there's been significant increase in supply, and there still will be increases in supply all along the riverfront there. I'd be very careful about some of those inner city apartment markets, just because they can be easily replicated. And then what happens, like, remember, Terry, maybe 10, 15 years ago, buying an apartment in Brisbane was flavour of the month. There was so many spruikers selling off the plan apartments. Now, because of the increase in supply, a lot of the pricing on those just flatlined for 10 years thereafter. Now, during COVID, there were significant gains throughout Brisbane. A lot of those apartments went up. And then we saw an exodus of a lot of investors that had held on, held on, held on. And they went, oh, I'm not going to hang on to that Brisbane apartment again because it just didn't do anything. So, not saying apartments in Brisbane generally will do well, but just be very careful on the specific location, inner city locations as well, because they can be easily replicated. Terry, just before we go on with any more questions, I'll just quickly share my screen and just I've got a couple of specials to mention to everybody as well. So if you want further information, please reach out. Terry and I will send through a copy of the recording to anyone that wanted to watch any bits again or missed it today. We'll just go to the next one. But just in terms of, a little special for our services as buyers agents, these are the types of services we offer. If you're looking to buy a home or investment property or commercial property, we can do all of the steps for you that we mentioned along the way. As I mentioned, our typical clients have come from all different backgrounds, from finance to construction workers, doctors, nurses, etc. And these are the 7 steps we go through that we talked about. But in terms of the special, I just want to mention our fees are typically a flat fee, ranges between 1.5% to 2% plus GST. And we charge an engagement fee of 3,000 to 5,000 plus GST. So what we're offering is, obviously, if you engage us, you'll get one-on-one personalised strategy, access to off-market properties, using lots of great research and having someone get you the best deal. And what we're offering today, we thought we'd get in the spirit of Black Friday, Terry, and we're offering a 10% discount off our engagement fees for anyone that signs up and engages us before December 20th this year. So keep that in mind. We'll send that around as an example, as an opportunity for you. So I'll just go back to the screen. Terry, just to finish off, is there any other advice you'd give if someone's just thinking about and fresh face to property investing in 2025? What do you think is the smartest way and safest way they can get started next year?
Look, I think the best advice is always build your team before you build your portfolio. I think it's really important for people to be willing to invest in advice and information. You can't penny pinch your way to success with real estate investment. Far too many people try to do that. Spend the big money on the real estate, but not spend a relatively small amount of money on advice. And I think that's the worst kind of false economy. So be willing to gather around you, have a good accountant, have a good mortgage broker, engage a buyer's agent. I mean, I've been doing this for over 40 years. I always use a buyer's agent when I buy. I like to have another set of buyers on what I'm doing, but it's also a great time saver for me. So don't be afraid to invest money in experts to make sure that you make good choices, because the ones who penny pinch on that often end up buying badly, and their grand plan of developing a portfolio is stillborn right at the beginning because they haven't been willing to actually invest smartly in good advice and information.
Yeah, fantastic. Well, Terry, I think that's about it, unless you had any other questions at all.
Well, the final question we were planning to end up with was just ask each other if you had to pick one standout location for 2025, where you'd put your money,
Yep.
what would it be and why? So
Okay.
I've got an answer to that. Do you have an answer
I
to
do have an
that?
answer to that, Terry. So if I had to pick one area for me to invest, where to put money. For me, I mean, it depends. Like the answer to this question is very personal because it's going to depend on your personal situation, what properties you've got in which states, you're minimizing land tax, diversification. But for me personally, I'm going to be sticking with Brisbane. I'm actually going to be actively looking in Brisbane to buy my next property next year. In fact, I'm just going through my pre-approval process right now. Um, I'm sticking there, even though the growth of interstate migration might be slowing a little bit. I still think there's going to be low vacancy rates, incredible opportunities to get good yields, and so that's where I'm going. If I had to pick a secondary one, then I'd be seriously be looking at Melbourne, and that's where I'll be looking after I bought in Brisbane, Terry. What about for you,
Yeah.
Terry? What's your standout?
A difficult one to choose just one, but I would say the Sunshine Coast, and not because I live close to it, but the Sunshine Coast is a serious regional city. The big infrastructure spend in recent years has just taken it to a whole new level. It's a classic second wind market. It had magnificent growth for 3 years. For the last 18 months, it's been flatlining, and I just feel that it's ready to rise again. So now is an opportune time to buy in that market. It's no longer a particularly cheap market, but there are some affordable options again in the apartment market, and you can buy well-located apartments with by the ocean, spectacular views, quite affordably in many parts of the Sunshine Coast. So that's the one that really stands out for me. It's the right time in the cycle to be considering the Sunshine Coast again.
Brilliant. No, I totally endorse that as well, 100%. I think, really proactive council. They've beautified all those foreshore areas around Mooloolaba, Alexandra Headland, Caloundra. They're absolutely stunning. So, yeah, lovely part of the world to live. Well, look, we're just about to hit 1:45. Thank you so much. Sorry we didn't get to a couple more questions there, but please reach out to us if you've got any questions. Love to help you on your property journey. Terry, if people want to get access to your reports, what's your website?
Yeah, hotspotting.com.au. And if you're interested in the research portal, which I sort of shared partway through the presentation to highlight some of those markets we think were second wind markets, be happy to chat to you about how you can gain access to that kind of facility, which a lot of people as investors find really useful.
Fantastic. And if you like to follow me on Instagram or Facebook or get my market updates in my blogs, just go to propertybuyer.com.au. I'm sure a lot of you are already following me and my market updates and anecdotes. So please go there if you'd like to get any help in buying your next property or negotiating. We'd certainly be delighted to be on your side and help you get a great result. So that's at propertybuyer.com.au. So I'm Rich Harvey, CEO of Property Buyer. Terry Ryder, thank you so much for joining us today.
Yeah, been fantastic, Rich. Love this conversation. Let's do it again soon.
Absolutely. Have a great Christmas, everybody. Be safe, and we'll look forward to seeing you again very soon. Bye for now.